Hello, everyone. As Amy indicated, I'm Ava Archibald. I am the principal in charge of our wealth transition services for the firm. And if you're not familiar with that service line in our firm, we're the group that come into play when our tax leads or our clients need estate planning. We work on the compliance returns of estate, gift, tax, generation skipping tax, fiduciary tax. And we many times work with clients when they're doing succession planning. And with our clients, a lot of times that becomes business succession planning. When we're transferring a business down to the next generation, looking at how we best do that in the most tax efficient manner. So for me, when I'm looking at a successful estate plan, it really becomes kind of four components coming together. The first one is us assessing what we have before us. What are the assets of our client? What are the current planning documents? And how does that play out if something happened today to our clients? Then we look at what are some planning opportunities that might benefit our clients, and it becomes maybe an education, making sure that our clients understand the planning opportunities that we may be suggesting to them or just informing them about. Along with that is illustrating. Again, we're an accounting firm. We're doing our planning from a tax perspective. We want to show the numbers. What does that plan look like? Taking information from maybe the legal team, the financial advisor, putting that together and illustrating what it looks like from a cash flow and a tax perspective so someone can visualize what this plan will look like. And then the most important part that I believe makes or breaks a plan is the implementation. You can spend a lot of time and effort and money putting a plan together, but if you don't implement it and carry it out as it was intended, that plan is not going to save you the tax dollars or really even the personal goals that you had for your family. So in looking at a plan, we have to know what is the current environment we're in. So I'm going to touch briefly on some legislative updates and some recent developments. Under the current law that we have today, we have a unified exemption for gift and estate tax. We also have an exemption of the same amount for generation skipping tax. So if you're not familiar with generation skipping tax, that's a tax assessed if you go over your exemption amount when you're transferring assets to, say, a skip generation, like not your child, but your grandchild, or maybe a trust for the second generation or future generations. If you transfer more than the exemption amount to that generation, there is a tax involved. The estate, gift, and the GST exemptions are all the same right now. And in 2022, they're $12,060,000. And we just received the updated numbers recently for 2023, and that is $12,920,000. So that 2023 number increased significantly in the last year, $860,000. That's the biggest jump that I remember for some time, but it's indexed for inflation. So that really makes sense for us that that number for 2023 is going to increase significantly. The tax rate has stayed the same. Progressive tax rate is 40% this year and next year. Portability for deceased spouses' unused exemptions is still available. This is a great planning tool that's been around here for a number of years, where if I died and I didn't use all of my exemption on my death, my husband could make an election or my personal representative and make that portable to my surviving spouse. So today at $12,060,000, if I died and I didn't use my exemption, because let's say I left all my assets to my spouse, I get a free marital deduction of anything I leave to my spouse. So then my husband could make that election to pick up that $12 million and use that for his benefit. I'll touch on that a little more in a few minutes. Sunsets, we still have a sunset provision in place that happens on January 1, 2026. That sunset was put in place when we had an exemption for $5 million. So they said they increased the exemption, and then they said in 2026, we're going to drop it back down to $5 million index for inflation. Where or with, our increased inflation here, this might be, we used to think somewhere around 6 million. It might be hitting closer to 7 million by the time we get to 2026. But under the current law, we do know that it is written that that exemption as we have it today will drop somewhere between 6 to 7 million. In addition, you have annual exclusions you can use every year. This is a gift you can make that doesn't dip into your exemption dollars. It's like a bonus amount almost, you could think of, that you can give annually to any person. It's $16,000 for 2022, and 2023 they increased that to $17,000 per person. So as a husband and wife, you could give in 2022 $32,000 to your child, and you would not have to use any part of your exemption. But be aware that if you are both going to give that exemption and you're going to use this $32,000 amount, if you're giving it from one spouse, you need to file a gift tax return to split it, even though giving an annual gift exclusion does not require a gift tax return to be filed. But if one spouse is giving the amount that you want to split between two spouses, you do have to file the gift tax return. In the last couple of years, if you've heard any of us speak here from the firm, we talked a lot about estate tax proposals. There were numerous proposals with various enactment dates that happened over the last couple years, probably more than I think I've heard in my 30-year career. So it's been an interesting couple of years, a lot of activity and discussion happening. And the things that have been discussed with these proposals or what have been brought to us with these proposals is comments about dropping the estate and gift tax exemption, changes to the annual exclusion, changes to the generation skipping rules, changes to the valuation rules. So under the current law, if I make a gift and it is something that's not a controlling interest, or it's a partial interest, such as a partnership interest or a share in a company, if it's not a controlling interest in that company, I can discount it for gift and estate tax purposes for lack of control, lack of marketability, sometimes between a range of 20 to 35%. So for gift and estate tax purposes, that's a significant tax savings when we can discount those gifts when we're giving them away or if we die with those assets. Other changes that have been discussed are changes to grantor trust agreements. So if I create a grantor trust, that's a trust that can be an irrevocable trust. So I make a gift to a trust and it's out of my estate for estate tax purposes. I use my exclusion today, but I leave enough rights in that trust so that I'm still the responsible tax party. And you think, why would I want to do that if I gave the asset away? Well, if I can pay the income tax for the beneficiaries of that trust, that's a free gift that I'm giving to those beneficiaries. It doesn't count towards my annual exclusion. It doesn't count toward my exemption. So if my cash flow allows me to pay the tax for the beneficiaries, that's a great way to reduce my overall estate. Those comments and changes to the grantor trust have been around, but that was a topic of discussion in the last couple of years for sure. There also was a discussion of limiting the terms of grantor retained annuity trusts, referred to as a GRAT under an acronym. That has not gone through, but they wanted to set guidelines on the terms that you would use under those types of techniques. And I'll have an illustration of that type of technique here going forward. Now, all the proposals, those are changes that happen or brought before the House and the Senate. We have to have a vote to pass those. That didn't happen. But we also have every year the Treasury who will prepare their priority guidance. So they have issues that they want to bring up or change or clarify under a Treasury reg. Sometimes I think about these priority guidance and the regulations that are set by the Treasury is if you can't get it passed through Congress, Treasury sometimes creates a reg and it changes through the Treasury. So this year, the priority guidance has 8 bullet points for us. Some of the items on these guidance plans come and go, and they are there for a number of years. It's interesting here that we had 8 that were on the plan, and it's updated quarterly. In the August report that came out, 4 of them have been addressed already this year. That's, I think, more than what we usually see. So for these, I'll go over them quickly. One was a estate tax closing letter, that there's a user fee to get a closing letter. One is consistent basis reporting. So when you file an estate tax return, you have to provide an informational return to the IRS to report the basis of those assets, so that the IRS can track that basis of the assets that the beneficiaries are receiving. They want to clarify those rules. There was also discussion about anti-abuse amendment to anti-clawback regulations. So if you're not familiar with the clawback term, that's a term that came about when the exemption is at a high level and it's going to potentially drop. The concern was that would the IRS, would the IRS, when the exemption drops, try to claw back the benefit a taxpayer had in the earlier years. So if I made a gift when the exemption was 12 million, and then I died when the exemption dropped, maybe after 2026, would the IRS penalize me and I'd have to pay the tax on that difference? Final regs came out in 2019 that said no, there would be no penalty. Well, then going forward here this year, they issued some proposed regs to try clarify what that meant, because there's this special rule that you won't have clawback under that final reg. But what this reg said is that doesn't pertain to all transfers. I think there was a lot of miscommunication when that first came out, and the fear was that clawback was coming back. It's not. Clawback is still not an issue, other than for those select gifts that are a reported gift when I make it, but because of some control, it's reported on my tax return. For example, if I give a quarter of land to my son, but I reserve an income stream, and I did that in 2022, I'd report that gift in 2022 at the full value. Then if I died 10 years later and I had this retained income stream from that quarter of land, I'd have to report that gift on my estate tax return as well. So in this case, if that exemption drops in 2026, I've had 12 million of exemption in 2022. If in 2026, I have to put that property on my estate tax return, and it's more than the exemption that is there in 2026 or later, then I will have tax to pay. So it's only going to affect assets that are reported on a gift tax return that come back and are included on your gift tax return. That's only select assets. Most assets will not have a clawback issue. Other things that were addressed is events with how you value assets on the date of death, or how you value assets 6 months later on an estate tax return. That's called an alternate valuation date. So especially in this environment with the change in the economy, I may die, or maybe I died in November of 21, but 6 months later, the market has dropped considerably. If I'm going to pay estate tax, I'd want to take an alternate valuation date and pay the tax on the value 6 months later. If I sell those assets in the meantime or distribute them, there needs to be guidance on how you address those. And that's what's going to happen here under the plan. They're going to clarify how you address those changes. There's also comments for guarantees and deductions on the estate tax return, looking for clarification how you allocate the GST exemption, that exemption that we can use for those gifts going to the generation skipping level, or your skip beneficiaries. Addressing the tax for U.S. citizens and residents who receive gifts and bequests from certain expatriates, and regulations regarding the actual use or the actuarial tables in valuing annuities, interest for life on term of years, and remainder or revisionary interest. You also may have heard over the years of the Secure Act. That came out at the end of 2019. This act is one that actually did pass, and this addressed retirement accounts. So prior to this act, you would have a retirement account, and if it was paid out to your beneficiaries, they could take that payout over their life expectancy. The Secure Act changed that and only allows you to pay out your retirement accounts over a 10-year period unless you are a certain eligible beneficiary, which are listed here. It's if you are a surviving spouse, a minor child of the decedent, a beneficiary who's disabled or chronically ill, or a beneficiary who's no more than 10 years younger than the decedent, you still have that stretch payout of that retirement account. If you don't fall in one of these buckets, however, then you have a 10-year term that you need to pay out your retirement account. When this act came out, we all interpreted, or most national commentators interpreted that language to be that you didn't have to pay anything in the years as long as you made sure you paid out that benefit in the 10th year after the decedent died. Well, then proposed regs came out this year in February of 22 that said, no, they're giving clarification here. They clarified for us better what these buckets are that they created of eligible beneficiaries. But then they also clarified this 10-year rule. That 10-year rule under the proposed regs say you have to take the required minimum distribution of that beneficiary based on, their calculation, at least the required minimum distribution every year, and then make sure the whole account is paid out in the 10th year. Now, if you don't take that payment every year, you could have an excise tax, and that excise tax is 50% of the distribution. So it could be a considerable tax or penalty tax for not taking that distribution. That caused a lot of concern because as professionals, we've been telling people, you have 10 years to pay it out. You could pay it out on the 10th year. No, that's not what was said in the regs that came out. Then now in October, the IRS issued a notice that said they'll waive the 50% excise tax on the certain required minimum distributions for 21 and 22. So that's all leading us to believe that the final regs are coming to clarify that, yes, it is going to be a 10-year rule. You are going to have those required minimum distributions. We're still waiting for the final reg, but we know we have the IRS that gave their notice and guidance saying they'll waive the excise tax for these 2 years. To me, that's acknowledging this was unclear. This is great. However, there's no clarification if you still have to take the required minimum distribution. Hopefully the final reg will give us clarification on that, but at least we know we don't have to worry about the penalty. Some taxpayers were very concerned about that when these proposed regs came out, and they paid the penalty in 2021. Now, if you did pay that penalty, under this notice, you can get your penalty back. So that's beneficial for our clients, but I'm anxious to see the final regs, and we'll see what they say. But we know this is all leaning toward that there's going to be required minimum distributions for those 10 years. Another issue I want to mention is we track all year long different tax court cases that come about to just keep an eye on what the IRS is ruling in different court cases to see how that plays out for our clients. And this one to me really hit home. In this Smaldino case, it was a great reminder of why implementation is so important in a plan. I've said for years, let's make sure that our tax returns match the gifting that our clients have done and the documentation matches, but it's easy sometimes to miss those steps. But this case is a reminder that that's jeopardizing your plan before the IRS. In this case, we had a husband and wife who owned a business entity or owned an asset, and they wanted to use the wife's exemption. So they transferred the assets to the wife, and then the wife made a gift so she could use her exemption. Many times we say, don't, if you're going to do that, give it to your spouse, let it sit for a while, make sure your spouse is making their own decision on making that gift, and give some time in between that transfer. Here they did it within a matter of days. So when I first read this case, I thought for sure that's going to be the issue with the IRS in this case, but it wasn't. Their issue was they made the transfer from the husband to the wife, and then the wife gifted. But in the control documents for the entity or the operating agreement, they didn't add the wife as an owner on their exhibit of the operating agreement. The wife never signed to agree to the terms of the operating agreement. And under the operating agreement, the parties had to agree to make transfers to someone like the wife, and there was no agreement amongst the owners that she could come in as an owner. And then the tax return was prepared, and the tax preparer did not show the wife as an owner for a couple of days. So if you have a K1, let's say in a partnership return, you'd show that transfer going to the wife, even though it might be income just for a couple of days on that K1 for the wife. You should at least document that she was an owner for tax purposes for a few days. They didn't do that here, and the IRS questioned and threw out this gift because of those reasons. So if you're going to do the gift, make sure all your documentation reflects that gift and it really does flow. Your intentions need to be documented. So this is just a good reminder for all of us to watch and be sure that all the documents from your legal team to your financial advising team to your accountants all match together. Now, in this kind of strange environment we are in currently, I wanted to think about actions you need to consider, or things if you're thinking about planning, what you should consider. And the first one is something I've said, or I've talked about for quite a few years, I think. So you may have heard this before, but I'm going to say it again because I still find clients who have not quite grasped that this higher exemption we have today of 12 million, if you want to use some of this, what I consider the bonus, we know it's going to drop in 2026 to say, for simplicity reasons, I'll say 6 million. If it drops to 6 million and I have 12 million today, many clients think, well, I'll just give the top 6 or that bonus, and then in 2026, I'll still have 6 left. Doesn't work that way. If you're going to give any of your exemption, it goes off the bottom first. So if you're going to give 6 million and that exemption drops to 6 million, you won't have any exemption left when 2026 comes. If you want to do that, and maybe if you and your spouse want to make a gift, and if you think, well, maybe we should give 12 million, maybe we give that all from one spouse, so the other spouse still has their 6. If I gave 12 million from a husband and wife, thinking we're both going to use our 6, it's not using your top 6, it's using your bottom 6, and neither one of you will have any exemption left at the end of the day, or when we get to 2026. So it might be better if you're going to do something like 12 million, use all your exemption from one spouse, and then the other spouse at least has that 6 million in 2026 if it does drop. If, many times or for years, we've seen clients who make gifts, husband and wife, we split them on the gift tax return. It's kind of automatic. Now we ask that question, do we want to split that on the gift tax return? Think about that when you're having your gift tax return prepared. Do you want to split them, or do you want them all on one side instead of half from each? It might make a difference as you move forward. Planning with portability. Again, there was no talk of changes to this in the tax proposal. So that was great, because I think portability is really a benefit to our client as an after-death planning tool. So if you don't use that exemption on the first death and you make the election to pass it to the surviving spouse, that surviving spouse gets to use that exemption first. And that exemption, if it's 12 million today, it doesn't get adjusted for inflation like we do when we're alive and we have exemption. But that 12 million that gets ported to the spouse stays at that amount, even if the exemption drops later. So if the exemption drops in 2026 and you received exemption today from your spouse at 12 million, that's your benefit. The only way you'll lose that 12 million is if you remarry and your second spouse is deceased, because this exemption is available to you for your last deceased spouse. So if you have another spouse that becomes deceased, that's their exemption you're going to use. You will lose this spouse's exemption. So many times when we're working with clients, we really want them to think about having a plan that allows the flexibility to use portability or determine portability after death. Now, other things to think about in planning in today's environment, you know, at first when all these things started happening, the market's going down, inflation was going up, is it really going to affect our estate planning world? And the longer we go on, like, I think it's affecting our planning world. I have to think about plans more because I want to make sure our clients are planning for the unknown. You know, the increased interest rates. Last year, I would have been talking to clients about maybe you want to refinance your interfamily loans. If you have loans amongst family members or businesses, maybe you want to refinance those and do notes with a lower interest rate. Now, if you have interfamily loans, it's like, do you want to set up anything very long term? Because this interest rate is much higher than last year. So you want to rethink that. The volatility in the market, you know, if you gave something away and the value dropped considerably. So in the market, if I gave marketable securities in November of 21, they were at a pretty good value. Let's say the market didn't really drop until now we get into 2022. I used exemption on a higher value than what I have today. If it's a long-term gift, maybe not an issue, because we all hear from our advisors, you know, investing in the market is the long term. It will come back and go down again. We have the hills and the valleys. But if you did that gift and you needed to do something with those funds now and you're selling out of the market, maybe that wasn't the best asset to use. If we have closely held business interests, some closely held business owners in this environment are doing a tremendous job and the growth is better than ever. Others are really struggling. So if I have that business interest that really took the downturn in the value, I use the value when I gifted it might have been higher. So think through, how will this company look in the future if you're giving a business interest? Again, we have the ability to have lack of control, lack of marketability discounts, which should play into our decision because that's a real benefit right now while that's still available to us. But we want to really think through what type of assets we're using for those gifting. Inflation, you know, if we're going to use the benefit of the higher exemption and you're gifting away 12 million, that can be a big change to your cash flow. And when we think about planning, we always want to make sure that when we're planning, we want the cash flow for our grantor or the person gifting to still be at a comfortable level. So when they make this gift or they do this transaction, they still have their accustomed manner of living. But if I ask that client, what is it you need for your living today? If I asked him last November what that was, today that number might be significantly different. So now with this inflation factor that we have and just the expenses that we're seeing for families, I think we want to make sure we're giving a good cushion to make sure they have a comfortable cash flow. And the other thing I'm always thinking about is, where is this going to go with the upcoming elections? You know, what will happen in November? Who will have control of the House and the Senate? We want to pay attention to that. If there's changes happening, make sure we get those messages out to our clients. So there's a lot of moving parts here. Again, I think where we are today causes us to pause and make sure we're doing the right gifts and we're thinking through how they will be affecting both our beneficiaries and the grantors. So with all that said, I still think the time is now to plan. I've been saying that for a couple of years here too, because there are so many changes that are happening. But with portability and the flexibility that might be happening in the exemptions, I think it's important to review your documents and take a look at it. I just met with a family today where the spouse has died, and that plan was drafted years ago that funded a family trust, where years ago, funding a family trust to the exemption limit was not that large of a dollar amount. But now we're talking 12 million and close to 13 million next year. If you are putting all that into a family trust on the first death, in this case, there were no assets that were going out to the spouse, and that wasn't their intent. They didn't want everything to go into a family trust. And in this case, does that make sense? Maybe we should have given it to the spouse and made a portability election and let them take a second step up in basis on that second death. Because if I die with assets in my estate, my beneficiaries get a stepped up tax basis to the current value. If I put it in a family trust now, that's the basis it is on the day I died. If I would have left it to my spouse and then made a portability election and gave my spouse the portable exemption, my spouse, if they died 10 years later, the kids will get a new stepped up tax basis to that value 10 years later. That might be a better benefit. Drafting documents to allow that flexibility, I really think is a bonus for our clients. The other thing to think about in planning, there is a lot that took place in 20 and 21 with the threat of the exemption, and sometimes people were doing some significant planning in a very short amount of time. Maybe it's time to review those plans and make sure, did everything happen the way it should? Did we implement the plan the way we should? Do we have the account set up? Are the funds flowing the right way? Are the documents all matching our intentions? Might be a good time just to review some of those plans, because a lot of people were rushing to do some very large plans to make sure they could get it done before that exemption was threatened to be dropped, and then it didn't drop. But now is the time you have a breather. Take a look, see if everything was done correctly. And then if you're thinking about doing a plan in the future because you want to use this exemption before it drops, my advice to you is don't wait till June of 2025 to do that. Professional advisors are going to be busy in the years of 24 and 25 if we don't have any change to these sunset provisions. Make sure you're sitting in a right position if that's what your goal is to use that exemption at the higher level. Don't wait till the last minute, because you might be surprised that you don't have advisors available to help you get through it, or you're rushing through it, and that's when maybe there's a misstep or something isn't implemented correctly. So in this time where we are looking at using a higher exemption, and again, making a gift of 12 million is a significant amount of assets and brings with it significant cash flow. So sometimes people want to use that $12 million exclusion while we have it today, but they don't necessarily want to give up the cash flow. A great way to do that is through a spousal lifetime access trust, where you can transfer assets to a trust. That trust can name the spouse as a beneficiary, either a discretionary income and principal beneficiary, or you can make income allocated right to the spouse. But if the spouse receives the distributions or is the beneficiary of that trust, as long as the grantor, who was, let's say, the husband, gifted assets to a trust and the wife is the beneficiary, as long as they stay married and they share that income, they didn't lose the cash flow. So it's a great way with this economy we're in to use the exemption as we have it today, but not lose the cash flow. Now, if that wife passes away, those assets then go down either to a children or a children's trust. And if you plan for that in the future, not a problem. But what if you have an unexpected death? Are you comfortable losing that income flow? What happens if you become divorced? That's something you want to think about when you do these types of transactions. Sometimes spouses will look at doing a trust for each other. So they'll create a trust for each other. But if you do that, you need to be careful that you don't have the same terms in that trust, or it's not done at the same time, or it'll be looked upon as a reciprocal trust or identical trusts, and the IRS will not allow that. Also, if you're gifting the same assets, let's say you own a partnership, you each own 50% of the partnership, and you created 2 spousal access trusts, one for each of you, so you have the income flow from each side. But I'm giving my partnership units to my wife's giving her partnership units to me of the same asset. The IRS will look at that and say that it's all one and the same. You want to have different assets if you can, time between those trusts if you're going to do 2, maybe preferably in 2 different years, and different terms of the trust. So they are not going to be or have that risk of being a reciprocal trust and the IRS looking at it as one and the same. Take some planning and some maybe creative drafting sometime to just make sure they're different, but they still reach your personal goals. One family I'm working with right now, one is putting real estate in one trust, and the other one is putting your business interests in the other trust. So there's doing 2 spousal access trusts, 2 different years, different assets, really makes them different, and we don't have that risk of them being one and the same. Now, as to the cash flow, you could add a special power of appointment to the trust. So if a spouse is really concerned that, you know, if I give my assets to this trust and I name my wife as the beneficiary or my husband and they pass away, can I live without that income stream? Well, you could have an independent party name or add people or beneficiaries to that trust, either under a special class of persons, which may include a grantor or may not, or specific named persons who can be added back as a beneficiary of the trust. If you do that, you don't want that to happen the next day. You don't want to have the grantor create a trust for my spouse and then, you know, the next week, the independent parties naming the grantor back as a beneficiary. That is going to be looked upon as a step transaction. But if it's 10 years down the road or some major event happens where it makes sense that you're adding people back in to that trust, have an independent party name that person and they make that decision. The problem we have there is who's going to be the independent party. Sometimes it's hard to find that person who can be independent and that you can rely on making the right decision of when to add people back in. But I have seen it now, probably more often in the last year than I ever have, where people are adding someone back in or naming an independent person to bring someone back in. With the inflation and the economy where that is, I think we might see that more often than we have in the past. It does take careful drafting, so you're not jeopardizing yourself to include those assets back to the grantor. You want to make sure you are drafting that appropriately if you are going to take that step. Now, 2 estate planning techniques we've used a lot over the years. I just wanted to visit with a little bit because in the environment we're in today, maybe this changes how we look upon these opportunities that we have for our clients. So the first one is a sale to a defective grantor trust. Here, this is a planning opportunity we use often, especially if we have appreciating assets. We have a grantor who's going to sell assets to a trust. This trust is drafted as a grantor trust, as I think I described earlier today, a trust where it's an irrevocable gift, but it has rights that causes it to be taxed back to the grantor. If we create this trust in that manner, we can sell assets to the grantor trust and take an installment note back and not cause any capital gain to be generated, because this is a disregarded trust for tax purposes. So if we do this transaction, and let's say we are going to do $1 million, just for a simple example, I would have to have some kind of equity in this trust to make it a true business transaction. So I would have to gift $100,000 and then take a $900,000 note back. Ends up I have $1 million of assets here, but I only had to use $100,000 of my exclusion because I took a note back for $900,000. The benefit here is if the assets grow in value in that grantor trust, those are all outside of my estate for estate tax purposes. That installment note I come back at is really at a frozen value of $900,000. If I used partnership interest, let's say for an example, as my gift, the income earned on the partnership would go into a trust checking account, and then that trustee would make payments on my note. My note could be an interest-only note with no prepayment penalty, so I could pay just the interest amount and pay principal as available or refinance at the end of the term. The benefit of this really is that the growth is going to go outside of my estate, and what I'm freezing to me is the installment note. Now, when the lower interest rates were in play, this was maybe a easier technique to use, and it worked well in more situations because we only had to pay the interest payment back. We just had to make sure that the partnership, in this case, distributes enough assets to the trust to cover my interest payment on the note. But now my interest payment has tripled, so can they distribute enough funds to cover my interest payment? If not, then this might not be a technique that's going to work. We want to make sure the cash flow still works. In this case, if I'm on the fence of using my exemption yet, because I'm not sure if the exemption is going to drop in 2026, setting yourself up with this transaction is still a benefit, because I can get it all in place. And if the exemption is going to drop in 2026, or there's some change in the law along the way, I can just gift the promissory note balance back and I've used my exemption. I have everything already drafted in place. It's a quick kind of flip of the trigger to use the exemption. The other thing to remember here, we still have the valuation discounts. So that's still a positive for this transaction, because as I gift the assets to the trust, or I sell the assets, I'm still selling them at the discounted value for lack of control and lack of marketability. As long as those laws are still in play, that's a great bonus for doing these transactions as well. So still a great plan for many of our clients. Many of our clients, like I said, their closely held businesses are doing better than ever. But if you have a closely held business that maybe is in a questionable market right now, maybe that's not the time to do this technique, because I'm going to sell it on a promissory note. But if my value goes way down, my promissory note is still for the value of when the sale took place. So think it through and make sure it still makes sense for your particular situation. Similar technique we have here is a grantor retained annuity trust. This is the one that's on the priority guidance, where they want to set rules for the limit of how long you can do a grantor trust. Here right now there is the availability to transfer a grantor trust, where grantor transfers to a grantor trust and takes back an annuity stream. The annuity stream is set for the term that is set under this agreement at the time, and the interest rate at the time we do the gift. This has changed considerably here, because in November of 2021, the interest rate that you use for this transaction was 1.4%. Now today, in November of 2022, that interest rate is 4.8%. So when you're calculating in this technique, the annuity stream going back, your interest rate is going to be much higher. When I had a low interest rate, it really made sense, because if my growth rate here was anything over the 1.4%, it was a no-brainer. I was going to get appreciation out of this grantor's estate. But now, if I have to pay back a 4.8% return on it, and maybe my company in this market isn't growing at that rate, does it really make sense for me to take back that size of an annuity stream? So again, it's a great benefit where we can use discounted assets in doing the technique. That benefit is still there. So it's still a beneficial plan in that regard. But we want to make sure we're using the right assets here to do this. If we were using marketable securities and the market tanked for a time, that could be tough. Are we going to have the cash flow to make the payment? If it's a closely held business and you're one that's really doing well and thriving in this market, great. You might still do this. But if you're not thriving in this market, maybe this is not the technique for you to use at this time. So things to think about when you're planning, the techniques that worked well maybe in the past couple years. Now we want to just make sure that we're using the right assets and they still work for the particular client we're working with. In this time of planning where people are looking to use their larger exemption before it drops, we are seeing people gifting assets where they're gifting it right to the exemption. I want to do an assignment that's going to gift all of my exemption away in this company or in this asset. And that's fine. We totally understand why you would do that. But I just caution you to be careful if you're doing that and you're setting it to a limit of my exemption amount or to a dollar amount. Remember, if you're pushing that envelope right to your exemption amount, and if your gift gets audited and they increase that value, anything in that increased value is going to generate gift tax at 40%. So maybe you want to consider adding language that's saying, I'm going to gift a value of X, but as finally determined for gift and estate tax purposes, so that you can adjust it if they audit your gift and it becomes higher than the value you intended. So just be aware, if you are doing an assignment that's going to push your envelope right to the limit of your exemption, make sure you have the right language in your assignment that covers you if that asset is adjusted on audit. You'll hear the term a defined value clauses. That's what's used. That's what is these type of transactions are called. It's the defined value clause that's put in the assignments that allows you to adjust that. So just be aware if that's a technique that you're looking to use. Now, limited liability companies and family limited partnerships, do they still make sense in the environment we're in? And most definitely, I think they do for many reasons. If you're looking to maintain family assets for a successor's operation, such as a family farm operation where you need all of the land to be operated by one family member, or have all the land contiguously used together as that family farm, putting in a family partnership allows you to have restrictions so you can keep that farm operation together. That's just one example. If you have a business, a family operating business, and you have children working in the business and children not working in the business, this is a way to provide those children who are not active in the business to maybe have an economic benefit by holding a non-voting interest or a limited partnership interest, and give the operating child the voting interest or the general partnership interest. Other things we see is we still have the discounts for lack of control, lack of marketability when you're gifting your non-voting limited partnership interests that are not controlling. That's a benefit. It's easy to use your annual gift sometimes through these partnerships. And setting buy-sell terms for the family can be done through this type of arrangement. Maybe you only want this family operation to pass to lineal descendants. you can put those restrictions within the operating agreement or a separate buy-sell agreement. So these still make sense for many reasons. But if you're looking to do this just for the discounting, you want to weigh that out when we have this high exemption. You maybe don't want the discount. If we're now talking just about a $25 million exemption for a husband and wife, you might not want that discount to happen, because if I discount it, I don't get that high step up. So you might want to weigh out the time. If that's what you're doing it for, is to avoid estate tax completely, does it still make sense at your net worth and for your family to be having a discounted asset? It might make sense in 2026. So, think about that as well. But there's no bright line answer there when there's this move of this exemption if you're doing this just for discounting. I had one family that's talked about a family partnership for a number of years. They finally came to agreement. They're going to do the family partnership for the family farm or the family farming real estate. And now we have this high exemption that's coming up next year, and they've decided, I don't think we need it. We don't need the discount. As the exemption keeps moving up, they're going to wait closer to 2026 before they take that step. So as I finish off here today, I can't stress enough, implementation is key to a successful plan. You, again, can spend a lot of time, effort, money putting that plan in place. But if you don't follow through with the plan, make sure your core documents, your entity control documents, all match your intentions. You could be surprised, and you might not have a successful plan from an estate tax perspective if that's what your goal is. Administer the plan, follow the rules so the funds match the plan. If you have a grandchildren's trust you create, make sure you have a separate trust account and distributions are made through that account. If you do a spousal access trust, make sure that you have a trust account. And if it's an example I used as a partnership interest, if that partnership makes distributions, it goes to the trust account. Then the trustee makes distributions to the spouse in the spouse's sole account, and then that spouse can share it with whomever they choose to share, the other spouse, children. But you don't want to have that trustee making a distribution to the spouse and the grantor, husband and wife joint account, because I'm giving it back to the grantor. That kind of taints your whole gift. So in all of these things, make sure your flow is happening correctly, you have the right accounts made, and your documents and your tax returns all match. So with that, I think I may have a few questions.
Going back to the beginning, they just said, hope you discuss the impact of midterms. Might Dem with both houses bring back loss of setup? Step up.
Yeah.
Okay. So.
Yeah, and I assume he's meaning capital gains due now at death and the loss of the 1031 exchanges and other bad taxes. We don't know. I wish I could say where that would go. We're in a world that I have never lived through, with everything happening with Russia, the Ukraine, the gas prices, everything else. I don't know what will happen, even if the Democrats do come into control. What I do know, and what I've learned through my 30 years, is don't assume, because in 2010, I would have never thought the estate tax was going away. I would have bet money on it, and it went away. So short time, but it really did happen. So now we have this sunset provision that's going to drop to this ridiculous low amount, I feel. Will it happen? I don't know. What I do know is that's what's written in the law. I know not much is happening in Congress to change any laws. So I think for our clients, we have a responsibility to have them be aware of that exemption, have them be aware of what the laws are today, inform them of what those proposals are out there. But we really have to practice with what we have. Next one I see here is, what is current minimum interest to charge on siblings' loans to avoid gift tax? That is a loaded question because it depends on the term of your note, if you're short-term, mid-term, long-term, and your transactions. So if you have a specific situation, feel free to email me and I'd be glad to help. Next question, if you gift to a trust at today's value and it depreciates, you have screwed up, correct? This is kind of what I talked about. If you gifted something today and that exemption, or excuse me, and that value of that asset drops, you've made the gift at the higher exemption that you've used. Now, depending on the technique you use, if you do a sale to a defective trust, and I took back a promissory note, and let's say that business just totally tanks, there's no value left, you can default on the note. And then what's your downside? Just the cost of your professional fees and really setting it up, and that equity amount you put in. My example was $100,000 for $1 million gift. So I've used $100,000 of my exemption. In that kind of transaction, you can default on the note if it's written up correctly. So you have a little bit more flexibility. But if you're giving an outright gift and then the value changes, yes, you've used more exemption probably than you would have. That's where I think in this environment, we really need to think about the gifts we're giving, and will there be a change in that value? Last question was, does it make sense to gift somewhere between 5 million and 12 million if a person cannot maximize their 12 million before GST exemption sunsets? I have to read that one again. Does it make sense to gift somewhere between 5 million and 12 million if a person cannot maximize their 12 million before the GST sunsets? Well, you have two different situations there. Your gift and estate tax exemption, if you are looking at using your 5 million, again, you're using it from the bottom up. And if that is not a GST exemption, you'll still have your 6 million of GST exemption after that. So I think this one, if you have questions, you might want to reach out to me. I think this is going to be more of an in-depth answer than what I can give today. I think that's the last question. So thank you so much for spending the afternoon with us, and my contact information is here if anybody has further questions.